In our last video, we discussed the concept of global minimum corporate tax rate and how it has emerged with the goal of preventing multinational corporations from shifting their profits to low tax havens. But beyond setting the goal, there is a need for a set of rules that will guide the process of turning the vision into reality. In this video, we will explore these rules, known as the model rules that would serve as the foundation for this global tax revolution. We will discuss the scope of these rules, the timeline that will bring these changes into effect, and the expected impact this could have on the global economy. Stay tuned. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. To begin with, the model rules are designed to ensure consistency and coherence in the application of the minimum tax rate across jurisdictions. This consistency is crucial for minimizing opportunities for tax arbitrage and ensuring a level playing field for multinational enterprises. Essentially, the model rules provide the necessary guidance and framework for the application and calculation of the minimum tax. The critical elements of the model rules encompassing the global minimum tax rules, including the income inclusion rule and the undertaxed payment rule, as well as the expected timeline for the effectiveness of the model rules by domestic laws. Now, let's give detailed explanation of the global minimum tax rules, income inclusion rule, and undertaxed payment rule. The global minimum tax rules, as outlined in the model rules, are designed to ensure that multinational enterprises operating across borders cannot inappropriately reduce their overall tax liability through profit shifting and base erosion strategies. The income inclusion rule requires the inclusion of income that is subject to tax at a rate below the agreed minimum rate in the jurisdiction of the payer. This mechanism serves to address instances where income is subject to low or no taxation in the source jurisdiction, thereby necessitating its inclusion in the tax base of the ultimate parent company or a parallel taxpayer jurisdiction. Conversely, the undertax payment rule targets deductible payments made by multinational enterprises to related entities that are subject to low or no taxation. By identifying and adjusting for such undertax payments, the UTPR aims to prevent the erosion of the global tax base, ensuring that tax benefits are not derived from arrangements that result in low tax income. Together, the IIR and UTPR form integral components of the model rules, facilitating the implementation of the global minimum tax and addressing gaps that may lead to tax avoidance practices. Let's move on to the timeline for the model rules, expected effectiveness by domestic laws. The timeline for the expected effectiveness encompasses the legislative and regulatory processes necessary for the adoption and incorporation of the model rule into the domestic tax frameworks of jurisdictions participating in the OECD G20 Inclusive Framework. The coordination and synchronization of these efforts are essential to ensure a cohesive and harmonized approach to the application of the global minimum tax rate across participating jurisdictions. The expected timeline also reflects the collaborative nature of the inclusive framework and the commitment of member countries and jurisdictions to align their domestic laws with the model rules. Expected impact of model rules. Firstly, the implementation of the model rule is expected to yield a substantial increase in global tax revenues, with projections indicating an additional $150 billion annually. This projected influx of tax revenues stems from the enhanced ability of jurisdictions to capture taxable income that was previously susceptible to erosion and profit shifting strategies by multinational enterprises. Implications for multinational enterprises and high revenue corporate entities. The implementation of global minimum tax rules may necessitate a reassessment of existing tax planning strategies, particularly those designed to exploit variances in tax rates across jurisdictions. Multinational enterprises and high revenue corporate entities will need to evaluate the potential impact of the model rules on their tax liabilities, intercompany transactions, and overall tax structures. To ensure compliance and mitigate the risks of double taxation or unintended limitations on legitimate tax planning. Furthermore, as tax policies and regulations become more aligned across countries, it is more important than ever for companies to be transparent and keep thorough records to support their pricing and transactions between related entities. Consequently, multinational enterprises and high revenue corporate entities may experience heightened compliance requirements and reporting obligations to comply with the evolving global tax landscape. This heightened scrutiny necessitates greater diligence and precision in demonstrating the arm's length nature of intra-group dealings. Potential effect on global tax distribution and revenue generation. The model rules' expected impact also hold significant implications for global tax distribution and revenue generation. The concerted effort to address base erosion and profit shifting is poised to contribute to a more equitable distribution of tax revenues among jurisdictions by curbing tax avoidance practices and ensuring a more consistent application of tax rules. The model rules are expected to rebalance the allocation of taxable income and tax revenues, aligning them more closely with substantive economic activities and value creation. Moreover, the projected increase in global tax revenues could bolster the fiscal capacity of jurisdictions, enabling them to pursue public policy objectives and invest in essential infrastructure, social programs, and economic development initiatives. This in turn may contribute to reducing existing fiscal imbalances and addressing challenges related to tax competition and jurisdictional asymmetries in the global tax landscape. In summary, the model rules are a comprehensive framework designed to revolutionize global tax governance. By setting new standards, they will have a far-reaching impact, influencing how tax policies are developed and applied in an increasingly interconnected world. These rules are not just a regulatory shift, they represent a pivotal change in the global tax landscape, shaping the future of international taxation for years to come. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.